Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video. I just wanted to say this week I'm not going to be able to film this video, but don't worry, you're in good shape and you're in great hands. Ryan Littlestone, he's going to give you an update on what's going on this next week, so make sure you stick around. Don't go anywhere. But I do want to talk about a couple of things. First of all, volatility has really picked up this week. We're seeing stocks, at least at the time of filming, stocks are under a little bit of pressure as we're heading into the second half of the week. And that volatility provides you a lot of opportunity as a trader. So one of the best ways to be involved in the Forex Analytics community is to take an assessment with the Trader Funding Program. And if you take an assessment with the Trader Funding Program, you're automatically included in the Forex Analytics community for a certain period of time. So if you want to have access to larger amounts of capital to trade, this is the time to do it. If you want to pass an assessment when volatility picks up, this is the time that you want to do it. So figure out what account's best for you, whether it's a $250,000 account or maybe $1 million account or just a $25,000 account. Any evaluation, it's going to be easier to pass when there is more volatility, in my experience. Now, one of the other things I wanted to talk about before I pass you over to Ryan is make sure you check out our one-on-one coaching. You know, this is not something that everybody's going to want at every moment in time. It's something that you as an individual trader, you're going to find yourself in a situation where you're like, I might need a little bit of help. Well, check out the Trader, the Trader Coach platform, and you can take a look at all of our different analysts and different mentors that you can work with. Make sure you check out everybody's profile. Watch a video, a 60-second video on what they can do for you, and then go down below and see what their prices are and book your sessions. You can do it right from this platform right here. So anyway, without further ado, I'm going to pass you over to Ryan Littlestone. When I come back in a week's time, I will then cover, the new set of trade setups, and then also review the trade setups from the previous week. So have a great one. Enjoy your time with Ryan, and make sure you stick around. I'll see you soon.
Hi traders, this is Ryan Littlestone at Forex Analytics, going through the week ahead video for week commencing 22nd of April. Blake is off, hence why we had all that volatility on Friday. The Blake index, we should call it. When he goes on a break, we tend to get a bit of volatility. So I'm stepping in this week, and we're going to have a look at some assets and what's coming up for you. We're going to start off with what's coming up in the data this week. We've got a few bits of data out, some important pieces on the calendar we need to pay attention to. First up, on Monday, we have China and their loan prime rate decision. Two rates there, the 1 year and 5 year, expected to be kept unchanged, but they have been talking about further easing this year. So we need to keep an eye on whether they decide to do something there. The economic data in Japan looks to be steadying somewhat, so maybe they'll keep this one unchanged for now and keep things slow and steady and hope for a further improvement. This week starts the week of PMI data, the flash numbers coming through around the globe. That starts in Australia there, as you can see, where we get the manufacturing and services numbers out of Australia. Then into Tuesday, we get the rest of the PMIs coming through from Europe, the usual flash numbers dropping there. We'll be keeping an eye on manufacturing, particularly for countries like Germany, who are still running into contraction in their manufacturing data there, although services moved into expansion for Germany last month. So that was a little bit of a positive note for those guys. But for the rest, there's been an improvement in these PMIs in manufacturing, but still a lot of negative numbers there, as you can see, 46.9 there in France. So deep into contraction territory. We're looking to see if those improve. And then later in the day, we get the UK numbers as well, and as well as the US numbers via the S&P Global later on in the US session in the afternoon on Tuesday. So again, looking to see if those numbers continue to hold up. The UK numbers had been improving, but had a little bit of a pullback, expected to come in largely flat. US numbers as well had looking like they might just be easing a little bit. So we'll keep an eye on that. As always, we're data dependent mode at the moment in terms of what that means for the Fed and other central banks too. On Wednesday, we get CPI data out from Australia. So that, again, feeding into those expectations for the next RBA meeting. In Germany, we get the IFO numbers. So again, looking at whether things are improving. Again, these numbers have been ticking up a little bit in things like the ZOO and the IFO, where conditions just maybe some of those green shoots starting to bloom this spring. And then we get US durable goods in the afternoon, which they'll feed into the consumer side of the data points that we look at, things like white goods, and seeing if there's any wobbles or if the consumer, as we saw in the last retail sales, is still very buoyant. Canadian retail sales also that day as well on Wednesday. Thursday, we get, it's actually a holiday in Australia, so nothing from those guys over there. But for the US, the big data point of the day is that Q1 preliminary GDP number coming from there to see how much the US has been ticking along in the first quarter of the new year. If we go by some of the previous data, it looks like it's been doing okay. We're expecting to see Q1 coming in on the flash estimate at 2.5% there versus 3.4% in the last quarter, Q4 2024. This is a bit of a funny number because it also contains Q1 PCE, which, as we know from this preliminary data, is an estimate, particularly for March, because we've only had January and February's data. This is one of those funny times because on Friday we actually get the US PCE numbers for March. So it's always a little bit funny when we get these GDP numbers that contain estimated PCE numbers, because does it contain these March numbers? Is that going to be an indication for what we're going to see on Friday? So it's one of those uncertainties that crop up now and again during the calendar. Friday, another important day, this time over in Japan. We get Tokyo CPI numbers. Now, we had the national CPI numbers last week. They were for February. They were for March. These are now April data. So the first April data for Japan coming from the Tokyo numbers. They're expecting in that core number, you can see there, a little bit of a pullback again to 2.2% from 2.4%. Let's bring the number down to target. And actually, the Bank of Japan is one central bank that wants to see inflation moving higher and sustaining higher. So anything that's looking softer and trending lower that might go through that 2% target is going to put a bit of pressure on Bank of Japan rate expectations. And we get the Bank of Japan on Friday as well. So it's their next meeting that they announce on Friday. So that's going to be a big one to watch. Obviously, market wants indications of whether they're going to hike again or when are they going to hike again. A lot of talk from the Bank of Japan regarding FX levels as well, and some sources pieces saying that they're going to take less focus on inflation and a more broad view on what the economy is doing in general, and FX is playing a big part of that at the moment in its terms of how it brings inflation into the mix by higher import costs and the like. We know, obviously, the yen continues to weaken. So that's all going to be featuring for this meeting, the first after they ended negative interest rates. And so we all want to know what's coming next from those guys. And as I said, that ends with US PCE in the afternoon. And then that's it. Well, we've got Michigan numbers there, as you can just see they are final numbers for April. Those inflation numbers did tick up last time. So we need to see what happens with those. So let's look at some of the data that we've got coming up this week, what's going to move markets. As I said, we're all data dependent now. We heard from Powell last week. We've had other central bank meetings. So now we're back to data point watching and whether those rate expectations are going to change any which way for any of the central banks. Right, so let's have a look at some of the markets now, see what's going to be coming up, what's happened last week and what we're going to be looking for in the week ahead. So the euro had it took pretty much a week off from some of the volatility it's seen of late. Very soft week for the euro, really only a 0.1% gain on the week, and it remains down 1.4% on the month. As you can see from the chart there, we obviously had that big move the week before, coming in from the 108s all the way down to 106. most the bounce got to is up near 107, and that looked really half-hearted. And so now we've just been going a little bit sideways. The market obviously had that big hawkish shift towards the Fed and their rate cuts, or lowering rate cut expectations on the back of those CPI and PPI data. Then also we had Fed's power last week coming out, and sounding a bit more less dovish, if you like. Not didn't mention the line that it would be appropriate to hike this year. To cut this year, but said it's likely appropriate that they keep rates higher for longer. So maybe a little bit of a shift there. We know a lot of Fed members have been getting very more cautious about these inflation numbers. When we got these bounces in CPI January and February, a lot of them, brushing it off. Oh, you can't trust 1 month's data. Well, now it's got to 3 months worth of data with inflation looking very sticky, and they're all just starting to change their tune and, saying yes, pushing the higher for longer line. So that's keeping the dollar on the bid side, but it's now needing to get some extra impetus for the dollar, I think, to really strengthen, and that's what we've seen this week in a lot of currencies, and particularly euro dollar here. So holding this 106 line, but not looking like it's bouncing too strongly either. So looking forward this week, as I say, we've got all this data, the PMI data. May not be a huge market mover. The market now knows that we're cutting in June, according to all the bods at the ECB, that it's only going to take something, a big shock to come along that will change that forecast. And so the market is now set. We're getting a cut in June. What it's looking for now, though, is what happens after June. Are we going to get a secondary quick cut in July? Is that something the Doves are going to concede? The Hawks are going to concede to the Doves and give another quick cut? Or is ECB going to cut once and then sit back on their hands until maybe the next forecast meeting where they'll take the rest of the data? I think that's probably likely the case, unless we get inflation really dropping down towards target. So these data points, the PMIs, unless we get some big variations in the numbers, they're probably not going to move the needle too much for the euro. And so for the euro in the week ahead, we're really looking, it's pretty simple. 107, 106 is your range, and you need to take your cues. If we break either side of that, if it's to the upside 107, then that's likely to mean that there's been some easing on the US dollar side, the US side, and maybe we've got strength in numbers from the Eurozone data, and that's going to bring a bullish move for the euro. Otherwise, if we break 106, then all eyes are going to be on the 105 area, which is really the big level down here. A level I've traded quite often. It's a big, huge historical level. It goes back many, many years, but as you can see, we had a lot of action down here the last couple of years down at this 105 zone. So if we get through this 106 level, then I think it's probably not going to be long before we have a look at that 105 zone. That's going to be a big technical level that I'll be looking to potentially trade once again. Other than that, 106, 107 is your focus going into this week. We're going to have a look at cable as well. Apart from the PMI data, not an awful lot to look at for the pound in terms of data and events. We finished actually negative, down 0.7%, nearly down 1% on the week, remain down 1.8% on the month. So we're still looking quite bearish in liquidity. It did look like it might have been holding up a little bit last week, but Friday we had Bank of England's Ramsden touting that inflation could move down close to the 2% target, the Bank of England's 2% target, based on the next inflation reading. A lot of that to do with energy price caps kicking in again, where prices are going to be coming lower once more. But his choice of language was quite dovish, saying move close to, not closer to. So that got the market moving a bit more on the dovish side for the pound. As you can see, cable there moving all the way down through 124s and coming down towards testing the 61.8 fib of this move here that we got late last year. This strong rally we got down from near 120s, 120 and a half, all the way up to into the 128s, and so we're down at the 61.8 fib, just below here, 123.39. So that's going to be an important level. That's a bit of a last line in the sand for this trend that we've seen. So if that goes, then maybe we're heading all the way back down to the big 120 figure, and we'll see what that brings with it. I think the market's probably a little bit optimistic on how dovish the Bank of England may get. Yes, we may see inflation coming down quite sharply, but those wages are still quite high, as we saw in the jobs report, the last jobs report. So there's still some pressures there, and as is the case for the UK, inflation doesn't tend to come down as fast as it does elsewhere. It may do on these energy prices, but as we've seen, oil has been moving back high over the last couple of months, so that's going to be a pressure that feeds into the UK as well. So I think if the market thinks that the BOE can be dovish, I think it's still going to be having to wait quite some time. The difference between what's happened in the euro and what's happened in the pound has shown itself in euro sterling. This one, those of you who follow us on Forex Analytics, ForexFlow for a while know this one's been doing absolutely nothing for several months. Since February, been stuck in this really tight range down towards the low 85s, up towards the high 86s. But that turnaround in the quid late on Friday has given this one a knock up to the 86 level. So finally sort of maybe busting about this 85-70 level that we've been mooching around for quite some time. Again, I don't see any real reason why this should have a significant move higher. But if we can get above 86, 86.20 and hold it, then we could have a push up to the higher parts of the 86 level, maybe towards that 87 level. This, again, another big level, 8,500 as a level I've been trading off quite some time. I'm still long off this level, so I'm going to be looking to take some bits and pieces off up in this 86 zone if we hold it, or indeed if we fail, then I'll look to take a bit more profit off the table. But it's looking like a good range play. I'm like playing it from the long side. As I say, I don't see any fundamental reason why this pair should be moving significantly higher. But we've got further data out, as we said, this week, so maybe there's some differences between the UK PMIs and the Eurozone PMIs that may change the picture here. Let's go over to dollar yen and see what's been going on there. Not a lot. We're playing another game. We had this game at 152 where we sat trying to break it for several weeks and we couldn't do it. Now we're doing the same thing up towards this 155 level. Now again, we've got the Bank of Japan, we've got this data coming up this week on Friday, so it's a bit of a way to wait, so lots of water that can pass under the bridge before we get to that data point and the Bank of Japan. But we're still knocking our head up here, and this is still a pair I'm not too keen on trading at the moment because we've got the volatility involved. We've got this risk of Bank of Japan intervention. You get a little bit of a spook in the market, even on risk, and you see the yen gaining and yen pairs falling quite significantly, as we got last week on those Israel headlines. We got that move down into the 153s, but boom, it comes right back up again. So the only aspect you can take from this pair is that dips are bought quite aggressively. Now, if that's the way you want to trade it and buy those dips for rallies back to this 155 area, 140, 154, 70, 80s highs, then be my guess. But you do still face that intervention risk, and I'm just, as I say, loath to really trade this one significantly up here. So again, if we do break this level, it could mean that we get another leg up, we bust through that 155 area, and we get the same sort of price action that we got at 152. It's building up that way where we get a significant top forming. That means every time sellers come in against that level and push it back down, likely their stops are building. So I think we need to see what happens at 155 because we're stopping some 20, 22 pips short of that. So there's probably maybe some barrier action going on there as well. So we need to see what happens if we break this 80 level. Do we then find more resistance into 155? But as I say, watching this picture over the days ahead, if we find a solid top up here and it builds in the same sort of pattern that we saw at 152, if we get a break, it's likely to be just as explosive. And then again, we're asking the question, is that too much for the Ministry of Finance? And is that too much now for the Bank of Japan and its monetary policy? And do we see coordinated action between both of those, either with monetary policy moves or with intervention. We'll take another look at, or we'll move on to dollar China. As we said, we've got just a quick look at China because of those rate decisions. Now, as I said, China looks like it's stabilising at the moment in terms of what it's doing with its monetary policy, in terms of what's happening with the economy. We've still got a pretty weak inflationary, I wouldn't call it a spiral, but an inflationary picture, weak inflationary picture in China, and that's not really being resolved yet. And while that isn't, that's going to keep easing bias to their monetary policy. For now, they're keeping the yuan level pretty stable. They're not allowing it to move any which way particularly. There's a lot of influence in the dollar in this pair, obviously. So some of these moves higher we've seen in dollar yuan have been on the back of the dollar rather than weakness in China. But that's something the Chinese have been fighting against, getting their state banks coming in to intervene in the market. Now, one of the reasons I like trading dollar China, and I'm still short up from those highs around the 736s, is because they're very explicit about what they will let the currency do. If they want to let this go to 750, then they will take their foot off the brake pedal. They'll stop letting their banks intervene. Any economic weakness, any dollar moves, we'll see this moving up quite significantly. That's when you can go with it, when they're happy to let the currency move in any direction. Conversely, if they say, we're not going to allow this one-way traffic further high side or weakness in the yuan, that's a good cue to potentially get short, because they're not going to let it go, and they've got the toolkit and the ammunition not to let it go. So that's when you might see this pair falling quite significantly. And again, if it goes too far, they will be verbal about it and say, hang on a minute, this is going too far. That's you. If you're trading that, that's your signal. Get out of any shorts and maybe even look to turn the other way. So very explicit for this, but as you can see, we've been really steady for the last 3 months. So it's not ready to bust a move just yet, but when it does, you'll know about it, and hopefully know about it in advance so you can trade it. Now, as we said, currencies generally have been fairly quiet on the whole, but one pair that's been making quite some waves is the Mexican peso. And as you can see from dollar Mex, we had a real big spike. Now, that came over the Israel retaliation that we saw last week. So a bit of a risk move more than anything. And obviously, that came in the Asia time zone. So when you're trading something like the Mexican peso, it's not a big currency, not a lot of liquidity going through that in that time zone, hence why we likely saw such a big move there. But what's significant to me is the fact that it did move that much. We've seen recently that Bank of Mexico, they might be entering their cut cycle. We saw, even after that, dollar Mex started making new lows, even with that. So that sort of went counterintuitive to what you would expect a currency to do when a central bank is entering easing mode. But then we've had this hawkish twist in the dollar on the back of the data, the inflation numbers, and we've had some significant rises. Now, what that tends to tell me, and even this big spike move, is that maybe shorts are starting to get very nervous down here. We got that next leg lower when we broke through that 17 level, moving all the way down to 1620s. But then perhaps the market's thinking, maybe that's as far as we're going to go. And so they're getting a bit more nervous. So anytime something happens that causes a rally in this pair, perhaps we're seeing a lot of, even if it's just short-termers, just throwing in the towel, a bit more cautious about their positions. So I think maybe that's what we're seeing in this volatility at the moment, that if this is going to be moving back up again, everyone who's been short for this carry play for so long is going to get more nervous, and they might be a bit quicker to exit. As we said, this is a big, big carry trade. So anything that tips a balance on that, and you're likely to see people folding and getting a bit more scared than they have been. Big levels up here. We really got to ignore this spike for the moment because it came in such a time zone where there's low liquidity. The big level for me is way up at 1850. If we get above that, we had that previous move up there after we made these lows, back late last year. that's where we bounced to. That's when similar situation, we saw maybe some of the short, some of the carry traders getting a bit chased out of their trade, but we hit a big level and we couldn't get through it. Down we came again. So that's going to be the big move there. There's a lot of work to do right now, but while we're way above this sort of 1700 or 1705 area, if we hold above there, then that's going to potentially give it a springboard for another move up towards 18. So this one, again, a lot to focus on regarding what happens with the dollar. Just looking at some of the commodities, we'll have a look at oil. Now, this one, again, it's been a bit of a risk player, but there's been a continued bid in it since late last year. So even with all these risk events that we've had with Iran, Israel, it's been one of these situations where it looks like all that has just been a bit of action for show, just to show the world and to show their individual populations, Iran and Israel, that they're ready to respond to any hostilities. The targets that Israel hit were an airfield and a military base, nothing in the general population. So it was, finitely targeted to cause not too much damage. And that is what's got the market, rally on quickly on these headlines, risk headlines. And then soon after, when the details are known, we see a bit of a reversal. Oil's topping out, US oil's topping out around this 87.5 level. So that's given us a little bit of a technical level, what to look at moving forward. If we get further risk headlines, are we going to break above there? If these PMIs are good this week, that's going to input something for the demand side for oil, particularly manufacturing. So that may be a reason why we see oil gaining. But for now, we've got a pretty strongish trend, I would say, since the beginning of this year. It's not looking like it's going to go completely in reverse. So we've got this level 80.50s, 82 level that has been a bit of a resistance level quite some time, a support and resistance level going back into last year. So that's really the 80.50 level is where you're going to be looking for support. If you've been long this or want to get long this, that's the sort of area you want to be looking at. It's a nice clean level at that 80.50s. If we bounce from there, then maybe we have a little bit of a range play up towards those highs. Otherwise, back under that 80.50, something is probably changing, and you might see further longs head into the exit door that were in this rally all this year. S&Ps, we'll take a look at stocks. They're right under the cosh at the moment. Have I even got it on there? Nope. So let's go into that quickly. There we go there. So this one's, they're really taking a battering at the moment, stocks. The S&P finished the week down 3% and is now down 5.1% on the month. So a real big turnaround. It's really carving through the levels at the moment. You couldn't sell it for more than a couple of days or a couple of hours in the early part of this year through January and February. But now we've got what's looking like a real turnaround. If we look at the overall trend, let's just zoom that out a bit. If we look at this trend that started really late October, in that context, this is still looking like it might only be a bit of a pullback because we've not even got down to the 38.2 fib of this whole move. Now, I know a lot of people are taking fibs from the midpoint here, this sort of second phase, second leg up, and that's fine, but I like to look at the trend as a whole, and this is the trend as a whole. So that 38.2, which comes in just above that break area that we got, 48.10s. So it's going to be a very, very big area if we continue to head lower down towards that. Now, shorter term, as I said, all the way up, we couldn't break down, we couldn't even test really some of these support areas. We had a couple around here, 50.40, 50.50. The break there looks very significant. As you can see, last week we had a move down towards that level. We couldn't get through. Then we had a break on Wednesday. Technical break confirmed because we had a bounce back into that zone and we held that zone again before this next leg lower. I was talking on Thursday, Friday about this 5K level in the S&P. It's been a bit of a technical level when we moved up towards it. As you can see there, we had plenty of support and resistance coming in against it. I think this was important for where we closed on Friday. The fact we closed below, and as you can just see, when we had that breakdown, we had just a little candle afterwards holding it. That's significant because it's showing that the market was really wanted to get that S&P down below 5,000 on a weekly close, which then, you know, gives sellers the real impetus to keep pushing this further and further, because the bulls just seem to be running to the hills at the moment. The next technical level, as you can see, is down into the low 49s, 49.18. The low last week, just getting fairly close in the 49.20s. This area here is just another one of these zones that I was marking on the way up, where we hit a high a couple of times, then we had a break, then a bit undecided, and then when we made the break, it held and it became support. So this 49.10 area, 4900 is going to be the next important level before we get down to this big area down here, which was the break point of this whole rally and where it all began. So a lot to look at for stocks here. We know that we've always got the Mag 7 that didn't put in very good performance. Companies also like ARM having a very, very poor week. Companies like Netflix as well posted good earnings, but then decided to announce that from next year they won't be giving subscriber counts, which when you're a subscriber-based business, that's what Wall Street wants to know. How many subscribers are you getting? So they've decided they're not going to publish those numbers from next year, which the market didn't take kindly to, because it's a bit of perhaps an indication that things might be getting softer in that side of things. So altogether, there's not been good news for stocks, and as we said, the Mag 7 numbers really, or Mag 7 companies really doing a lot of driving in this as well. We've got further earnings, plenty of earnings coming up this week. So we'll see what those bring as well. And that's going to bring me to the end of this week ahead video for you. I hope you enjoyed it, and join us at Forex Analytics next week, and we'll keep you up to date on everything else. Have a great week, everybody. Good trading.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.